Welcome to our latest video on real estate investing. In this video, we'll be discussing the top 5 mistakes that new real estate investors make and how you can avoid them. Investing in real estate can be an excellent way to generate passive income and build long-term wealth. However, it's essential to understand the common pitfalls that many beginners fall into, so you can avoid making the same mistakes. By the end of this video, you'll have a clear understanding of what to watch out for and how to set yourself up for success as a new real estate investor. So, let's dive in and get started. Lack of proper research. One of the biggest mistakes new real estate investors make is not conducting adequate research before investing. Failing to research the market, the property, and the financials properly can lead to significant financial losses. To avoid this mistake, it's essential to do your due diligence and research the market thoroughly. Look at the current trends, the demand for housing, and the potential for appreciation. Research the neighborhood and surrounding areas to ensure you're investing in an area that has a good potential for growth. Finally, don't forget to research the financials, including any financing options, taxes, and insurance costs. Make sure you understand the potential cash flow and returns on investment before making a purchase. By conducting proper research, you'll be better equipped to make informed decisions and avoid costly mistakes. Underestimating expenses. Many new real estate investors fail to account for all the expenses associated with owning a property, such as maintenance costs, property taxes, insurance, and property management fees. This can lead to cash flow problems and negative returns on investment. To avoid this mistake, it's important to create a comprehensive budget that includes all expenses associated with owning the property. This should include ongoing maintenance and repair costs, property management fees, insurance, and property taxes. Additionally, it's crucial to have a contingency fund set aside for unexpected expenses, such as emergency repairs or unforeseen vacancies. A rule of thumb is to set aside at least 10% of your rental income each month for unexpected expenses. By accurately estimating your expenses, you'll be able to determine the true cash flow and return on investment for your property, and avoid any surprises down the road. Over-leveraging. Over-leveraging, or taking on too much debt, can be a significant mistake for new real estate investors. It may lead to a high debt-to-equity ratio and increase the risk of foreclosure or bankruptcy. To avoid this mistake, it's important to be conservative when it comes to financing your property. Don't borrow more than you can afford to repay, and consider putting down a larger down payment to reduce your monthly mortgage payment and interest charges. It's also important to have a solid understanding of your financial situation before investing in real estate. This includes your income, expenses, debt, and credit score. A good rule of thumb is to have a debt-to-income ratio of 43% or less and a credit score of 620 or higher. By avoiding over-leveraging, you'll be able to minimize your financial risk and ensure that you're able to manage your property effectively over the long term. Lack of diversification. Many new real estate investors make the mistake of putting all their investment capital into a single property or type of real estate. This can be risky, as it leaves the investor vulnerable to the fluctuations of the market. To avoid this mistake, it's important to diversify your real estate portfolio by investing in different types of properties and in different geographical locations. This can include residential, commercial, and industrial properties, as well as properties in different neighborhoods, cities, and even countries. Diversification can help mitigate risk and provide a more stable return on investment, as different types of real estate may perform differently in different market conditions. It's also important to consider other investment options outside of real estate, such as stocks, bonds, and mutual funds. This can provide additional diversification and reduce your overall risk exposure. By diversifying your real estate portfolio and considering other investment options, you'll be able to create a more stable and diversified investment portfolio and minimize your risk exposure. Ignoring property management. Many new real estate investors make the mistake of assuming that managing a property is easy and can be done on their own. However, property management can be time-consuming, complex, and requires specific knowledge and skills. To avoid this mistake, it's important to hire a professional property management company, or at least consult with experienced property managers. They can handle tenant screening, rent collection, property maintenance, and other day-to-day tasks that come with owning a rental property. Property managers can also help you set appropriate rent prices, reduce vacancies, and ensure that your property is up to code and compliant with local regulations. Even if you decide to manage your property on your own, It's important to educate yourself on property management best practices and stay up to date on changes to local and state regulations. By not ignoring property management, you'll be able to avoid costly mistakes and ensure that your rental property is running smoothly and generating the maximum return on investment. Thanks for watching our video on the top 5 mistakes that new real estate investors make and how to avoid them. We hope you found this information helpful and informative. Remember, investing in real estate can be a fantastic way to build long-term wealth, but it's crucial to understand the potential risks and pitfalls. By avoiding these common mistakes, you can increase your chances of success and achieve your financial goals. If you have any questions or comments, feel free to leave them down below. And don't forget to like and subscribe to our channel for more valuable content on real estate investing. Thanks again for watching, and we'll see you in the next one.